You check your portfolio on a Tuesday afternoon. The market is down 12% in a week. Your stomach drops. Your hands feel cold. Something in your chest tightens. You tell yourself you are being rational. You tell yourself you are protecting your capital. You sell. 3 months later, the market has recovered everything it lost and then some. You are sitting on the sidelines, watching gains you would have captured if you had done nothing. You buy back in. The market dips again. You sell again. You repeat the cycle until your portfolio is smaller than the money you originally invested. You are not unlucky. You are not uninformed. You are running software that was written 200,000 years ago, and it is quietly destroying your wealth. Now here is where it gets genuinely interesting. In 1979, two psychologists, Daniel Kahneman and Amos Tversky, made a discovery that reshaped how we understand financial decisions. They found that the psychological pain of losing $50 is approximately twice as intense as the pleasure of gaining $50. Read that again. The same amount of money moving in opposite directions creates emotional responses that are not even close to symmetrical. Loss hurts twice as much as gain feels good. That is the asymmetry. And it is not a character flaw. It is neurology. Your amygdala, the ancient part of your brain responsible for threat detection, does not distinguish between a stock market correction and a physical predator. When your portfolio drops, your amygdala fires the same alarm it would fire if you were being chased by something that wanted to eat you. Cortisol floods your system. Your heart rate increases. Your decision-making narrows to a single imperative: make the threat stop. Selling feels like escaping. Selling feels like safety. But selling at the bottom of a dip is not safety. It is the most expensive decision you can make with your money. But here is the thing. Does this affect everyone the same way? It does not. This distortion does not affect everyone equally. It affects intelligent people more. Because intelligent people can simulate outcomes with vivid detail. You can see every scenario where the market continues to fall. You can calculate exactly how much you might lose. You can build a rational, articulate, sophisticated argument for why selling right now is the prudent decision. Your intelligence is not protecting you. It is being conscripted by your fear response to construct a justification for an action that your emotional brain already decided to take. And that is the part that makes this so difficult to fix, because you do not experience the panic as panic. You experience it as analysis. You experience it as caution. You experience it as the responsible thing to do. Your brain dresses a biological threat response in the language of financial prudence, and you cannot tell the difference. The more intelligent you are, the more convincing the disguise becomes. Consider what happens inside your body during a market correction. Your eyes land on a red number. The information travels through your optic nerve and reaches your thalamus, the relay station of the brain. From there, the signal splits. One path goes to your visual cortex, where you consciously register the number. The other path goes directly to your amygdala. The amygdala responds in milliseconds, before your conscious brain has even finished processing what the number means. By the time you think, "I should probably sell," your amygdala has already been screaming for several seconds. Your body has already released stress hormones. Your heart rate has already elevated. Your blood pressure has already risen. The decision to sell was not made by your prefrontal cortex, the rational, deliberate, analytical part of your brain. It was made by a structure that predates language. Your prefrontal cortex was not making the decision. It was drafting the press release. That is the trap. And it has two halves. The first half is what psychologists call the disposition effect. Investors sell their winning positions too early, to lock in the good feeling of a gain, and hold their losing positions too long, to avoid the pain of realizing a loss. The result is a portfolio where your winners are cut short and your losers are allowed to bleed. You are systematically keeping your worst assets and discarding your best ones. Not because you do not understand investing, because the emotional architecture of your brain will not let you do otherwise. Think about what happens when a stock you own goes up 30%. You feel a warm glow, a small hit of dopamine. You want to crystallize that feeling. Selling converts a paper gain into a real gain, and the realization feels like an achievement. So you sell. You lock in the win, but you have also cut off the compounding. That stock might have gone up 200% over the next 5 years. You will never know because you sold to feel good now. Now think about what happens when a stock you own goes down 30%. You feel a pit in your stomach, a cold weight. Selling would convert a paper loss into a real loss, and realizing that loss feels like failure. It feels like admitting you were wrong. So you do not sell. You hold. You tell yourself it will come back. You tell yourself you are being patient. You tell yourself that only fools sell at a loss. Meanwhile, the position continues to deteriorate. Months pass, sometimes years. The loss deepens. But as long as you have not sold, the loss is not real. It is just a number on a screen. And your brain prefers an unrealized loss that is growing to a realized loss that is fixed. The asymmetry is devastating. You sell your winners at plus 30%. You hold your losers at minus 60%. Over time, your portfolio becomes a collection of your worst decisions. And you made every one of those decisions in the name of emotional comfort. The second half is what I call the re-entry problem. When you sell during a dip, you feel relief. The threat is gone. But the market does not care about your relief. It recovers on its own timeline. And now you face a new psychological obstacle. To buy back in, you have to admit that selling was a mistake. You have to purchase the same assets at a higher price than the price at which you sold them. Your ego resists this. Admitting you were wrong is psychologically painful. Buying back in at a higher price means accepting a loss that did not have to exist. You sold low, and now you are buying high. The same asset, the same company, a worse price. Your brain calculates the difference between what you sold at and what you would be buying at, and it registers that difference as a penalty, a self-inflicted wound. So you wait. You tell yourself you will buy back in after the next dip. The dip does not come. The market climbs. You watch from the outside, and the wealth you would have accumulated compounds without you. Weeks become months. Months become years. The gap between where you are and where you would have been grows wider every day. But because you never took the action that would close the gap remains invisible. There is no red number on your screen showing the gains you missed. There is only silence. And silence does not trigger a response. A study by Dalbar, a financial research firm, has tracked this pattern for decades. Their annual quantitative analysis of investor behavior consistently shows that the average equity fund investor earns significantly less than the index itself. The S&P 500 might return 10% annually over a 20-year period. The average investor in those same funds earns roughly half that. Not because the funds performed poorly, because the investors bought and sold at the wrong times. They bought when markets were high, because optimism felt safe. They sold when markets were low, because fear demanded action. The gap between investment returns and investor returns is the cost of loss aversion, measured in real dollars, over real decades. Now here's where it gets genuinely remarkable. There is a way out, but it is not what you think. The answer is not better information. You already know that markets recover. You have seen the charts. You have read the studies. Knowing that the S&P 500 has never lost money over any 20-year period does not help you in the moment. Because the moment is not governed by knowledge. The moment is governed by a biological threat response that fires before your rational brain is even consulted. The answer is not more discipline. Discipline is a finite resource. It is the ability to override your impulses through conscious willpower. And willpower depletes. Every time you resist the urge to sell, you spend a unit of discipline. Every time you check your portfolio and see red, you spend a unit. Every time you read a headline predicting a crash, you spend a unit. Eventually, the supply runs out. And when it runs out, usually during the worst possible moment, when the market is at its lowest and your stress is at its highest, you sell. Not because you decided to, because you ran out of the energy required to not decide to. The answer is what I call structural decoupling. You remove the decision from the moment of fear entirely. Instead of deciding whether to sell during a market correction, when your amygdala is screaming, you make the decision now. When you are calm, when your prefrontal cortex is fully in charge, you write down rules, not feelings. Rules. Rule 1. You do not sell during a market decline unless a specific predetermined condition is met. That condition is not a feeling, it is a number, a valuation threshold, a percentage decline that triggers a rebalancing protocol, not a panic exit. You write this rule down before you invest a single dollar. You write it on paper. You put it somewhere visible. And when the market drops and your body fills with cortisol and every fiber of your being is screaming at you to act, you look at the paper. The paper does not feel fear. The paper does not feel anything. The paper remembers what you decided when you were rational, and you follow the paper. Rule 2. You invest automatically on a fixed schedule regardless of what the market is doing. This is called dollar cost averaging. You invest the same amount every month whether the market is at an all-time high or in free fall. Over time, this means you buy more shares when prices are low and fewer when prices are high. You do not have to time the market. You do not have to feel brave. You just have to show up. The automation removes you from the equation. And that is the point, because your participation is the variable that introduces the most risk. Rule 3. You reduce how often you check your portfolio. Every time you look at a red number, your amygdala fires. Every time your amygdala fires, the probability that you do something stupid increases. Checking your portfolio daily is not diligence. It is self-inflicted psychological damage. Check it monthly or quarterly. The market does not need your supervision. Your attention does not improve your returns. It only improves your odds of making an emotional decision that destroys them. Rule 4. You separate your investing account from your checking account, not just in different institutions, in different mental categories. The money you invest is not available for withdrawal. It is not available for a vacation. It is not available for a new car. It is not available for anything except compounding. When the money is structurally inaccessible, the temptation to pull it out during a moment of fear becomes a logistical barrier rather than an emotional decision. You have to fill out forms, you have to wait for transfers, you have to go through steps that take time. And time is the enemy of panic. Fear is fast, logistics are slow. By the time you have navigated the logistics, the fear has often subsided. And if it has not, if you still want to sell after going through every step, then maybe you should. But most of the time, the barrier is enough. Most of the time, the structural friction saves you from yourself. And here is the insight that ties all of this together. Loss aversion is not something you overcome. It is something you design around. You do not defeat your biology by being smarter. You defeat it by building a system that does not require you to be brave in the moments when bravery is biologically impossible. That is the game. Wealthy investors are not emotionally superior. They are not wired differently. They are not immune to fear. They are structurally protected. They have removed their own hands from the wheel during the moments when their hands are most dangerous. They have built systems that act on their behalf when their biology would paralyze them. And those systems, running quietly and consistently over decades, do what no amount of willpower or intelligence could do alone. They compound. The question is not whether you can control your fear. The question is whether you have built a system that controls your behavior when fear takes over. Have you ever sold during a market dip and regretted it? I genuinely want to know what happened. Tell me in the comments below. And if this changed the way you think about why you always sell too early, subscribe, because this is exactly the kind of conversation we have here every single week.